Welcome to another episode of Wealth Strategies Unleashed with Concenture Wealth Management. I'm Robert Gilliland.
I'm Karen Hyder.
And welcome. Hey, one of the things back in the mid-90s was a book by a gentleman named Harry Dent, wrote a book called The Great Boom Ahead, and he talked about how birth rates affect the stock market. Mm-hmm. And he was spot on for a long time. And his whole premise of his book was, if you look at birth rates and you add 46 years and you look at the ages of 46 to 52, you could then overlay the S&P 500 and have a prediction as to where the markets were going to go. And so much, in fact, that he said that the markets, which by the way, the Dow Jones Industrial Average was less than 2,500 when this book came out. He said that it would peak at around 18,000, and that peak would happen in 2017.
Wow!
Now we're much past that.
Mm-hmm.
But I think there are some thoughts and some ideas from Harry Dent in this great boom ahead when you look at demographics now that make a lot of sense that we can go through and continue to apply. As an example, the reason why I said 46 to 52 is that's generally when you were in your peak spending years. Mm-hmm. That's when those 2.2 kids were costing you the most. That's where you were paying for college, and you were also earning more money than what you ever thought that you would earn, right? And so all of that was fine and dandy, and then we've had some things happen. Market is significantly higher. We didn't have this fall off of a cliff. Let's talk about what happened that prevented this great boom ahead from going through and continuing, and where are we now, and what does that mean about the future? And so the nodding of the head means, okay, let's go. So, I mean, if you go through and you think about this, right? The great boom ahead, there were some we've had some events happen in this century that probably changed that, right? Like the Great Recession.
Oh yeah.
Like how do you think the Great Recession changed the way people view money, the way they invest, how they earn?
I think it was definitely an impactful time. How many clients have we sat across from them and said there is a lot of fear in investing now after the Great Recession with the dip that the stock market took, with the housing crash and everything that happened back then? I think a lot of people view how they invest a lot differently after that time period.
Well, not only the Great Recession, right? That you're exactly right. That changed people's relationship to money. Now there was risk that they weren't necessarily certain of. But then we had COVID.
Yeah.
Which changed the way that we live, even today.
Oh, yeah. Well, and changed it in so many ways. Changed how we look at investing. It changed how we operate day to day. Changed how we work, where we work. There's so many things that have happened as a result of COVID that have impacted our daily lives.
And as you're going, you take both of those, you back up. Now this is not the way you're supposed to do these, by the way, is that you don't start in the middle, then go to the end, and then come back to the beginning. In the beginning would be the tech bubble.
Yeah.
That's where we realize that stocks don't always go up. So this great boom ahead, that was this theory. If you think about it, there are a lot of things that are still intact with the great boom ahead. We have the baby boomers that are either in retirement or gearing towards retirement, and we've seen spending patterns change. Right? Spending patterns have changed. Like as an example, you want to move to the hill country, or you want to move to a beach, you want to get a beach house. The prices on those have gone up. And they haven't gone up just because we have people moving, U.S. migration, people moving from other parts of the country to Texas as an example. But they've gone up because the demand is so much greater. Right, because owning 100 acres in the hill country is an expensive endeavor these days.
Yes, it is.
Right. Think about cars. Right. Think about where that is now. The good news is that there's another generation that's actually larger than the baby boom generation, and that's the millennials, and we're starting to see it with Gen Z that are actually larger. So we're kind of maybe restarting this great boom ahead. But the spending patterns continue with those baby boomers, right? So the things that are important to baby boomers are healthcare, travel, the baby boomers are still young enough that they're not just staying in place. They're still going out and spending money, but it's a little bit different, right?
Mm-hmm.
When you think about when you go and you think about, and you've been doing this for 10 years, we've seen clients who have changed their kind of spending patterns. So when we think about these crises that clearly had an impact on Harry Dent's thesis of the great boom ahead, and that is people who are 46 to 52 in their peak spending years and the market following that. We've seen a lot of changes in the way that people do that. So like through the Great Recession, through COVID, people's spending patterns, we've seen clients, right, spending patterns have changed. Have kind of from an overall high level, do you think that it is most people are spending less today than what they thought they would spend, or more?
I think you have to look at it two different ways, whether it's short term or long term. I think in the short term, right now, post COVID, and probably the same after the Great Recession, I'd say on average, people are spending less. We haven't quite gotten back to the level that it was pre-COVID, where people are out traveling, taking cruises, doing all the discretionary fun spending that we were prior to that. But I think if you step back and look at that on a longer term trend, I think once we get past these big crises like we've had in the past, 3-5 years out, spending starts to pick back up. People get a little bit more comfortable with what's going on. People start to have more cash flow in their pocket, and their spending picks back up. So I think on a longer term trend, spending does recover. It just takes a bit to get there.
So here's the question for you, that as you're kind of looking and you're thinking through and think about our clients, right? As we're thinking about our clients, one of the premise that he had is that as people get older, they move into retirement. There are certain things that they're going and doing. It feels like people who said, yeah, I want to take 4 vacations a year, have scaled them back a little bit. But they've started spending money a little bit differently.
Yeah, I feel like in the first few years when our clients retire, they do tend to spend kind of what they expected, or what we had talked about when we looked at budgeting and kind of what their needs were. But I think as they start to go farther into retirement, like you said, their needs change. They either discretionary spending kind of drops off, their total amount falls, or what they're spending on changes. So instead of the 4 to 5 trips a year or different things, now their focus is more on grandkids or experiences with their family and their grandkids, or helping out funding for grandkids' college coming into the future. So I think the amount of spending changes, yes, but also where that spending is going.
Yeah, and what's interesting, Harry Dent said there was going to be industries that were going to be impacted by this elephant going through the system, if you will, and the things that he talked about, they're still intact today. I actually think that his theory about this aging population and their peak spending years and that having an impact on the market is still intact. He just missed the timing.
Yeah.
Right? Because these retirees, your young retirees, let's call it that 55-year-old who just retires, you're exactly right. What are they spending money on? They're traveling. They're doing additions to the house. Or they're remodeling, or they're going on experiences.
Yep.
Right? Our clients who've been retired for a while, what are they spending money on? Healthcare, helping out grandkids.
Yep.
Those types of things. They're not maybe going out to dinner 5 nights a week. They're catching the early bird special, once every other week, right? And so, I mean, I think that his premise is still intact. The one thing I think that Harry Dent was not able, and who in the world would be able to do this in the early 90s, be able to go and say technology is going to make as big of an impact.
There is no way anybody could have predicted from where things were in the 90s with barely even having one computer in the home to now all of us having a computer in our hands on a daily basis. Man, the implications that has made in work and personal lives, there's no way anybody could have predicted that.
Yeah, and I think also one of the things is that government intervention has caused this boom to extend, right? The fact that we basically went to 0% interest rates in 08, 09, and you had a tremendous amount of money come into the system by the shoring up of banks. And whether or not that was a good thing or bad thing is a debate for a whole different type of podcast. But the reality is that a lot of money came into the system. that got us out of that recession. And then we had COVID hit.
Yep.
And I think given today where inflation is, most people would argue we probably did too much. That's the reason why we have such high inflation. Though it has been coming down, it's probably going to stay elevated. But that's caused the economy to continue to grow. Technology is going to continue to make it grow.
Yep.
Right? And you go and you think about how technology is actually impacting and where those opportunities are. So you still have opportunities in technology. You still have opportunities in healthcare. You still have opportunities in leisure and travel. Those things are all still intact and probably going to last a good couple more years as the baby boomers continue to age, actually get into retirement, and then you have the Gen X start to do it. You may have a dip inside there, but you have these millennials that are coming fast and furious. As you're looking at this and the fact that you've got baby boomers that are aging, spending a little bit less, clearly a powerful economic force. What are some things to kind of go to keep in mind as you're looking into the future and you're thinking about investing your portfolio now?
No, I think you have to be adaptable. You have to be ready for the fact that nothing is going to consistently stay the same. The things that worked 5 years ago may continue to work in a different way, or you may need to shift and find a different area for things that do work. So constantly being aware that you have to adapt and change to what the market is telling us at that time is important. You can't just set it and forget it.
The other thing I think that's important is we're talking about this when what Harry Dent was talking about was just inside the U.S. You have this phenomena continues. And if you go and you think about it, it's kind of like a clock. And so Japan was first, then the UK, now the US. Now we're coming back. And so look at emerging market. So I think it makes sense to pay attention to what's happening in the demographics of some of these emerging countries.
Yep.
Right? As they get better educated, as capitalism kind of starts to take hold, they are better educated, they demand more, they produce more, their economies start to grow. You have to be smart about that because those can be extremely, extremely volatile. The other thing that I think is kind of goes without saying is longer term investment horizons, and that kind of fits in our strategy.
Looking at things on a 10-year time horizon and giving things time to work and to shift makes sense.
And so, I mean, if you have a 10-year time horizon, odds are in your favor that you're going to end up, if you can keep money invested for 10 years. Now, that doesn't mean owning XYZ company as the right company to own, but being invested in that asset class is the right place. Being well diversified makes a lot of sense. So to kind of wrap it up, I mean, the takeaway that when you go and you look at the great boom ahead is that demographics have it is a major force in what happens inside of the economy. If you think about the 70s, you could buy a house and turn around and sell a house a couple weeks later, even at high interest rates, even in that economy, because the baby boomers were wanting homes. Owning companies like Procter & Gamble and Johnson & Johnson made a ton of sense. Technology goes and starts to take hold, right? Computers, companies like IBM, Dell, Compaq, now HP, start to take hold. These demographics and this demand for this really start to grow and push. And what we have is that just because the baby boomers are getting older, possibly spending less, doesn't mean that the growth in the economy isn't going to continue, because we have this huge, larger generation coming, the millennials that are coming. And what are they doing? They're having children. They're looking to buy homes because they want to move out of downtown and move and have a yard, right? They're paying attention to schools. And as you go through and you look at this, there's a ton of opportunities, and it's not just here in the US paying attention to emerging markets and picking your spots. So, I mean, I think that there's still opportunities in this market. The great boom ahead, the theory behind it does make sense and kind of still plays. And so with that, I'd like to say thank you for listening to this week's podcast, and we look forward to seeing you next week.
See you next time.